All right, so we've had a positive past 2 weeks for mortgage interest rates. Interest rates actually fell 8 consecutive days leading up into yesterday. Unfortunately, both Tuesday and Wednesday, we saw a small reversal for interest rates, but overall, we've seen a major positive sign move down since about January 15th. We're going to dig into why. And what we're seeing is we're just seeing overall continuing signs of a softening economy. First, ADP came out today. ADP came out with a big miss, 71,000 jobs being added. Projected was like 140. This was the lowest jobs being added since January of 2022 with the ADP report. Now, of course, this is supposed to be correlated to non-farm payroll, which comes out this Friday. And let me tell you, non-farm payroll is the biggest data report to come out in the entire month. So we'll have to see if it is actually correlated, and we'll have to see if non-farm payroll does come in lower than expected. In addition, CPI hasn't come out yet. It will come out Wednesday next week, the 12th, but we are seeing signs of inflation finally starting to cool down, and the worry that tariffs are going to increase inflation is kind of subduing. That being said, a lot of the tariffs really haven't went into effect, so we're really not going to see that play out until maybe end of Q2, Q3, see if prices do rise with that. But inflation is expected to come in at 0.2% month over month. Usually it gives a great indicator through these first 5 to 6, 7 days, okay? So now we can already see what March inflation is going to be. So the April 12th reading, right? So that one is projected to come in flat already. If headline inflation comes in at 0.2 this month and then comes in at flat next month, we will see the headline overall number move from 2.9 to 2.4. Mark this. It is what is today? March 5th, I think. March 5th. Okay. April 12th. That is, we know one's coming out March 12th. The next headline will be April 12th. CPI could fall from 2.9 all the way down to 2.4 in just literally the next 40 days, causing worry because right now, inflation has been trending up for 6 months. We'll finally see that break. It'll come down. It'll allow people to breathe. But the big data report we want to talk about today is GDP. If you are following this, you've seen GDP take a major shift in literally the last 7 days. The Atlanta Fed GDP predicts what the GDP is going to be for the quarter. Last week, 1 week ago today, the projected GDP was 2.3%, which kind of fell in line with like the last 6 quarters. Last 6 quarters, we've been ranging between 1.8 to about 3.5%. Nothing super robust, but nothing super weak, right? 2.3. Yet in just 7 days, we've now seen GDP move from a 2.3% positive to a negative 2.8% GDP growth. Let me reiterate, negative 2.8% GDP growth, and it's March 5th. We only have 25 days left in the month, and then guess what? We will have a negative GDP quarter growth. A recession is 2 consecutive negative quarters of GDP. We're 20 days away from one of those quarters being printed. Now, personally, if I could, I would be betting that GDP is going to reverse, and we're going to see GDP move more towards a flat number or more even a positive number. Because if you actually look at the data, why did GDP move lower? And there's 2 main reasons. One, is that there's a large theory that it's going to be changed, and the other one is important for all of us. But essentially, GDP is consumer spending, government spending, imports, exports, things of that sort. What it really changed is the imports, exports. We saw a ton of imports into the economy in Q1. Why? Businesses might be looking to import a lot of goods, stockpiling all of these goods. Why? Before tariffs. We know tariffs are going to be added, 25%, 10% here. If you know that something's going to be 25% more expensive in about 4 months, wouldn't it be advantageous for you to order all of these things now? So we saw a ton of imports coming to the economy. And remember, if you're ordering foreign goods, what is that not doing? That is not boosting the US economy. That is boosting outside economies. So what we do is we take imports and exports, we subtract the imports. So that is what we saw. We saw a major shift in imports that caused the GDP ratio to move down. Now, a lot of people believe, again, this is just going to be temporary. Why? Because a lot of people were stockpiling these goods in Q1. And you're not going to see that in Q2. You're not going to see that in Q2 because everyone has already stockpiled these goods. So that is a reason for negative GDP. But the other one that is very important is the consumer spending. We have seen consumer spending slightly been about 1 to 1.5% of GDP, attributed to that GDP growth over the last 6 quarters. Well, consumer spending was flat this year. Is the American consumer finally getting tapped out? It's been one of the questions for the last, 4 or 5 years. You see credit card debt at all these all-time highs. It's always seen the American consumer always remains undefeated, just always finds a way to spend. But if you see no growth in GDP numbers, then the American consumer might finally be feeling it. So if you're seeing all of these things, you're seeing that slowing job growth, slowing inflation, slowing GDP, what does it lead to? It leads to lower mortgage interest rates. And we know this is a big pivot for the Trump administration. They want lower oil prices. They want lower mortgage interest rates. They want these things to help fuel and stabilize the U.S. economy. So again, a lot of good reports. We'll see how it plays out over the next 3 to 6 months. We really need to wait and see how the GDP plays out, but it's good stuff for us. We're seeing lower interest rates, and if it continues, we could see lower interest rates on the horizon as well. If you have any questions, please feel free to reach out.